All right. Hello, everyone, and welcome back to the PetroNerds podcast. This is episode 49 of the PetroNerds podcast with an awesome treat today with none other than the CEO of Innovex, which I'm sure many folks are familiar with for a number of different reasons, which we will get into. But this is Adam Anderson, the CEO of Innovex. Episode 49 today is Wednesday, June 1st, 2022. As you know, Adam, I normally do a long intro with oil prices and everything. But before I get into that, I would just like to say hello and welcome and thank you for coming on the PetroNerds podcast.
Oh, thanks for having me, Trisha. Looking forward to it. I enjoy the show, so it's good to be on.
Awesome. Well, okay, cool. So today is Wednesday, June 1st, 2022. It is not very sunny in Denver, Colorado, which kind of sucks because it's June now, and we've had a bit of a late spring. But with that being said, WTI is hanging around this 115. It's 115.27. It's sort of hanging around 115. Brent, the futures, the month rolled over, so it was 120, but we've seen this drop from that rollover, so it's about 116.35 right now. Henry Hub is hanging at 870. So we're still hanging at roughly this under $9 mark. Dutch TTF right now in dollars per MMBTU. The European gas benchmark in dollars per MMBTU is about $27. And just for context, because I've added this metric, is a 30-year mortgage is 5.47. It spiked to over 5.6%, dropped back down, but that 10-year yield is what it tracks pretty closely, and you'll notice 10-year yields are up. We had a slug of data that's come in. I haven't got to go into it, but the Fed Beige Book just came out. I think it has some pretty mixed information for the market. They were talking about how consumers in most districts in the Fed Beige Book were starting to push back on higher prices, which is good and bad, but they were also talking about areas that were a little hot, and so obviously these high inflation reads. But this is the PetroNerds podcast, and there is so much going on in the oil market. So I was just talking with Adam about this before we came online. We haven't got a whole lot of clarity on the OPEC meeting just yet, exactly what was happening. So if you were following OPEC last night and this morning and yesterday, there was a lot of talk about OPEC and Russia and whether or not OPEC was going to sort of let Russia sort of sit aside or sit out this one. It's been pretty clear that Saudi Arabia and OPEC have been pretty good friends with Russia in this whole, the war in Ukraine. They've made it very... They've been worked pretty particularly to not to mention it as war. I think they accidentally said war once in one of their bulletins or briefings from their monthly side, but since then it's called a conflict, so they didn't even call it a war. And Russia has actually, if you look at the data, I saw it just from the Middle East Economic Survey, they're actually at record exports for seaborne crude shipments, so for outward crude shipments. So and then Europe has said yesterday that they are working to significantly reduce their crude oil volumes, basically getting rid of all seaborne imports to the extent that they possibly can. But what's really interesting is that India is taking over 1 million barrels per day right now. China's taking over 1 million barrels per day of Russian crude. And Italy's taking a lot of, Italy's shipments have went up to nearly 500,000 barrels per day. So lots of countries are sort of deciding, hey, this stuff is really cheap, and we're taking it because it's severely discounted. So I find that fascinating, and I'm sure we can circle back to that, but I just thought I'd open it with all that, give you a little food for thought.
Quite the backdrop.
Yes.
Interesting times.
Backdrop. Yeah, interesting times indeed. So with that, Innovex, I think a lot of people know you for obviously the North Face jackets, which is something you may or may not, the first thing. But obviously you are an oil and gas service provider, and you provide a significant need to the business. And I was going over the presentation you sent me, and I didn't know all this. Obviously, you're a private company, so I didn't know all these details about your business. So it's quite cool. And you're based in Houston, correct?
Yeah, I live in Houston, and our headquarters are here in Houston. We do a variety of things. So Innovex designs, manufactures, and sells a pretty broad array of products from the wellhead down to the toe of the well. Houston is home where we probably have 300-ish folks here in the greater Houston area between corporate, design, engineering, manufacturing. And then we can kind of tend to design, build, manufacture most of the stuff here in Houston. We also have a manufacturing facility outside of Dallas and Mineral Wells. We tend to design, manufacture here at the hubs. And then we've got probably about 30 service centers across the U.S. and all the major shale plays. And then we're also in about a dozen different countries internationally, from Canada to Mexico to the Middle East, and all the kind of obvious international places.
Awesome. And that's great because I really think, I think I've noted this on previous podcasts, but I always talk about in presentations stuff with clients. I think the service sector is highly misunderstood, not just in the US, but abroad in terms of really how pivotal the role is to the business. And, I would love to talk about sort of, I know you probably don't want to give proprietary information on pricing, and I'm not looking for that, but I'd love to talk about, the core of your business, some of the pricing, what you're seeing on, because, obviously your business, you're working directly with E&Ps. And I do think it's important to think about when I work with a lot of service companies and the portfolio and the interest in going abroad, not just, interest in getting purchased by whether it's private equity or moving stuff or by another company, but also the stuff that's going on abroad really to me flies in the face a little bit of the investment thesis that things, we just haven't picked up in the Middle East. And it seems like a lot of service companies based in the US are picking up significantly in the Middle East as well as here in the US. So, there's a number of things I want to talk about the core business, but I do want to circle back and touch on inflation and employment and, the components that you have for the stuff that you're building. If you're getting that, if you're struggling with that, where are those sort of pinch points and how have you guys, how have you maneuvered around that? Because you have some, your business, you have dissolvable plugs. There's different things in your business, and obviously you benefited significantly from, we're drilling fast. The wells being drilled in the U.S. are being drilled at a rapid pace, even with all the inflation and all the bottlenecks. The speed is still significantly up there, even with not having the right people. It's still up there. Lateral lengths are still increasing for the most part overall. And it seems like your business from your portfolio is benefiting from that. So, what is the core aspects of your? I would love to talk about dissolvable plugs and different nerdy tech stuff, but what's the core of the
get into all
business,
that.
and what sort of drives it?
Yeah, so from a very high level, just in terms of the different things that we do, you could categorize it different ways, but I think of it as five big product buckets. The largest of which is what we call well construction or cementing tools. So this would be float equipment, centralizers, stage tools, inflates, all things that are used to place cement in when you run a liner or a casing string. So that's the single biggest piece of our business. Pretty close thereafter is what we call our well completion piece of the business. So this would be things like frac plugs, toe sleeves, liner hangers, packers, and kind of a whole array of ancillary products around that. So those two are far and away the biggest pieces of the business. They might represent 70% of the business on a combined basis. And then the three smaller product lines, the next biggest one is our fishing tool product line. So a lot of people will be familiar with the Logan fishing tool brand. So this is a business where we design, manufacture, and sell fishing tools to the service companies. So to the Weatherfords or Wildcats of the world, for them to then go out and provide service on. After that is our production segment of the business. And this, for us, production is really providing ESP accessories, either to the E&P or to the ESP company, depending on where in the world we're operating. And then this last piece of our business is kind of a specialty drilling services business. So in this case, the biggest part of that portfolio is providing a product called the Swivel Master, which is really used in very particular high-end ERD wells. Think historically, Sakhalin Islands was a big market for that. A lot of the wells in Norway, say a troll field, for example. So wells where you tend to have very long step outs, relatively short TVDs, and you really need the ability to rotate drill pipe without rotating the lower completion. We have some specialty tools that are really one of a kind in our portfolio that do that. So those are kind of the five biggest buckets of our products. And to your earlier point, some of those things, the vast majority of those things are consumable products that are sold directly to the E&P or to the large operators out there. Tends to be in the U.S. It's almost exclusively to E&Ps, and then internationally it's a little bit of a mixed bag depending on where you're operating. And yes, we have a lot of manufactured products. We probably have 150,000 unique SKUs that we'll sell in any given year. So a lot of different discrete products. And all of those things take a fair bit of steel, cement, polymers, plastics, all sorts of variety of products. So we're definitely our supply chain leader, Ben Griffith, and our team there do a wonderful job keeping up with the last year of kind of craziness through COVID and then inflation to ensure that we're able to get what we need at a reasonable price and take care of the customer.
And so have you, I'm sure for some of these products you've done a little stockpiling because you want to, if you're presuming there's going to be more inflation, which there is going to be more inflation, or at least significant supply chain bottlenecks, if there's anything to do with Europe and Asia. So I presume you're certain areas that you're seeing in advance, you stockpile on that, and then you're able to at least keep prices somewhat steady for your customers.
Yes, we absolutely try to. Of course, it's a mixed bag because the biggest we're not a very capital intensive business, is one of the virtues of our space, but we do have a lot of inventory on hand. So that's one of the key things we try to balance is having enough inventory on hand to take care of our customers. And one of the natures of the U.S. oil field is that you have to be very responsive to our customers who might change well programs from pad to pad. And you need to be able to respond very quickly to that. So you need to have enough inventory on the ground to take care of that. And to your point, in these times where the supply chains can get disrupted in a way we've not really seen historically, you have to be able to navigate through that. We're fortunate in that the vast majority of what we do, most of the machining, most of the assembly is all done in the U.S. A lot of the steel products are U.S. based, although you have stuff coming from all over the world or globally. So we're not as exposed outside of a couple of very unique products to, say, a China situation where things tend to open and close in a less predictable manner right now. So we're able to be pretty robust against those kind of changes, but it's definitely a challenge, particularly given the number of inputs we need to build all the different products coming out the
Right. And it's not so much, I mean, it's not that when I think a lot of folks and myself comment on the China thing, Europe, it's not so much that a product is necessarily coming from Asia or coming from China. It's that is there some aspect of a product that's being disrupted by a supply chain? I think, most people don't break out, defining what exactly the supply chain is. But if it's that, if anything if it's not made
100%.
onshore US, or a piece of it's not made onshore US, then it has to be compiled. You could have 95% of it made here, and you're waiting for a little bit component, a chemical or something, a specialty item, and then that's held up. And I think that's in this business and many, many others, whether it's, tiny little aspects of the business that people wouldn't normally think is a big deal. Disruptions like a war in Europe have impacted stuff that, because Ukraine and Russia didn't just export energy or food. They actually exported a lot of metals and other things, and those have provided some unique disruptions, I think,
No,
to all aspects of
that's
business, not just oil
100%
and gas.
the case. Yeah, and we see it like in some. Your point is 100% right on. Is that for a lot of what we do, it's made in the U.S., but there is some small component of it. If you look at like some of the alloying elements, magnesium is a big one that we use a lot of. Almost all magnesium is made in China. Almost anything rare earth is made in China today. And in some cases, magnesium is one used a lot in dissolving plugs, but it's also used in alloying. And it's a very small piece of a piece of steel, but you need each and every one of those components to get the end product. So you're exactly right. You can have 96% of something, but if you don't have the last four, you can be pretty exposed.
So has that impacted any of the actual picking of products? And I kind of want to get into this. I want to loop back on the public, the actual E&Ps that you're working with and stuff. And I still want to hammer home some of this inflation bit and talking about how service providers needing to make money. But I want to talk about sort of the aspects of that you noted out in the presentation you sent me on, longer laterals, obviously, the intensity of the wells and everything, but the way your business fosters. And, those longer laterals, a lot of people often talk about the very end of that lateral and completing the very end of that lateral. And, years ago, there was a lot of fear, not even that long ago. Certain operators had a significant fear of drilling too long a lateral because they didn't think they could complete the last end of that lateral as well. And now that seems to be, a lot of that fear has gone away. Obviously, people have gotten more comfortable, not just drilling them longer, but actually completing them longer. And those dissolvable plugs and the stuff that goes on in the toe of the well, I'd love to know, how that's working. And if there's pieces of this business that, if folks can't get something, has the business sort of turned to, we find a different solution. It's very innovative, but I'm very curious on the, the toe of the well that you talked about in the presentation. What's that looking like, and how's that driving the business, and how's that sort of moving the needle in the U.S.? Because I think it's hugely significant. I know lots of folks in the U.S. know it. I don't know how many people that aren't deeply involved within U.S. shale really appreciate drilling a 3-mile long lateral and being able to complete the last half mile of that lateral accurately. That's a big deal. So you're not seeing diminishing marginal returns for that production.
Yeah. Yeah, so that's an area we spend a lot of time focused on in a couple of different ways. One of which is through the area of toe initiation. This is a big deal, as you know, in all these wells where folks don't want to have to go in with TCP or something and stimulate the wells. So we do a lot in the area of toe sleeves or wet shoes or things like this to enable a good cement job, allow our customers to get a good pressure test on the casing, and then ultimately open up the well interventionlessly to begin the frac process. That's a big part of what we do, and we do that. Has tended to evolve over the years to kind of very basin specific solutions. Where you'll see in the Northeast we do it one way, the Haynesville a different way, and then the Permian Basin is probably the most diverse, just given the geology out there. People do it different ways in different places. So that's one area that we're very involved in. The other area, to your point, is frac plugs. We're one of, if not the leaders in terms of the units of dissolving plugs sold out there. And we've been pretty big proponents of that. I think today that probably 20-25% of the frac plugs out there are dissolvable. When those products first came to market, I think very early on there was the promise that, hey, we could run all these dissolving frac plugs and flow the well back and not intervene on the wells at all. And I think pretty early on that was dispelled as just a bad way to do it, because you just produce so many solids into these wells. You need to get in there and clean all the debris out and ensure all that sand comes back to surface. So from the get-go in the dissolving plug market, at least when we entered it, I would say maybe 4 years ago, our focus was really on not telling customers we would eliminate intervention, but that we would make that intervention far simpler and more efficient. Through eliminating the actual drill out time, but also eliminating the amount of debris downhole, which inhibits the progression of the coil or the stick pipe to get to bottom. So yes, to your point, yes, we see much of that either in full laterals. A big part of our market is doing dissolvables from heel to toe of the well, but also we have customers who are focused, in your example of a 15,000 foot lateral, where they may the last 5,000 feet where they're particularly concerned about friction, want to get rid of the plug and be able to get to bottom just that much easier. And if, God forbid something happens and they're not actually able to get to the last 1,000 foot or something, they can come out a hole and have some confidence that those dissolving plugs are going to dissolve and be able to produce them back to surface. But I think in general, my view on it is, hey, I wouldn't want to drill a well so deep. You wouldn't want to depend on the dissolvable to go away, except for in very unique circumstances. Right. Without going in there to make some kind of clean out to ensure that all the debris is out of there.
Right. So it works on that. And then has that, the ability that, yes, you're still going out and you're still cleaning it out. But you're still doing that and you're still making sure things are okay. But has that helped to reduce the cost on that? I mean, has
100%.
Okay.
Yeah, that's our value proposition there, is that we're able to take that clean out from, let's say, a 2-day clean out down to a 24-hour clean out or something like that. So your total time on location, total cost, the risk that goes with it, all of that is reduced. That's primarily our value proposition. And so when we price these dissolving plugs, it's typically priced at a premium to a composite, but at a small enough premium where it's pretty easy for our customers to get their head around, okay, I'm going to pay a little bit extra for the dissolvable, but on the back end, I'm going to save that and some on all the clean out.
Right. And how much of that is are you seeing that uptake? I think in the Middle East, I always think about, I'm pretty bullish on unconventionals in the Middle East. I don't think people follow it as closely as they should. It's not as sexy and glamorous as it sort of is here. And a lot of people just don't realize that almost every single Middle Eastern country in the Gulf has at least a pilot project on unconventionals, if not significantly more. They've definitely struggled. There's cost components there, but I'm curious if some of the stuff that you're doing, and obviously you sell abroad, if that's having an uptake, and if that's you're seeing, I wouldn't say a step change, but more of a growth and adaptation, that they're sort of, these tools and stuff are benefiting, and they're listening to you and they're using this stuff in the way that they should be using it.
So yeah, we see some of that for sure. So there's two big unconventional markets that we participate in internationally, and that's Argentina and Saudi. So Argentina is a little bit closer to home, and certainly we're seeing some uptick in activity. In fact, as we speak, we have a fair bit of work going on with the dissolving plug business in Argentina. I think all those benefits we described are probably even more helpful in a place where you don't have the same level of service intensity that you have in the U.S. So I think that's part of the reason why that Argentinian frac market has gone so much to dissolving plugs versus composite plugs. The Saudi market, where we don't participate in quite as much, that those contracts tend to be turnkey contracts with the frac provider. So I think in Saudi, for example, Jafur is one of their big unconventional developments, and I think right now Schlumberger is doing the bulk of that work and provide. So we're not as involved and ingrained with that one. I know they've gone back and forth between composites and dissolvables. We do some toe initiation work in Saudi Arabia, but we're just not as active or as big of a part of our business as it is in the U.S. So I think that it'll be interesting to see how those projects play out over the years. I do think in some ways the U.S. has a very unique advantage in unconventionals because it's because of that level of service intensity, let's say, and the amount of capital service companies have
Absolutely.
deployed in the U.S.
No,
It's just not the
right.
same at all in Argentina or Saudi Arabia. So I think they may struggle. It'll take them longer to, I think,
It
crack
absolutely will.
the code and figure it out than we have here.
Yeah. The nimble,
Yeah.
flexible service sector, I think is such a critical component to how sort of the US took off. But that being said,
Yep.
I would imagine that you are seeing, and I'm asking if you're seeing at least an interest level uptick from folks, not just in Saudi but abroad, in terms of folks getting back to business and gearing up. I mean, I always say it's very hard at these oil prices not to see that. I mean, I can't imagine that at the very least the phone is ringing from different parts of the world, and that there's an interest level for that to pick up.
Yeah, I think broadly we're seeing that across the board. I think the first place, somewhat surprisingly, or maybe I say surprisingly, the first place we're seeing the ramp occur is in Latin America, actually, kind of from Mexico down to Argentina. In each of those basins, we're seeing, or each of those countries, we're seeing some meaningful increase in activity. Some of those were particularly hard hit during COVID. So if you look at Colombia, Ecuador, Argentina, they got down to almost zero activity, and they've really ramped back up pretty quickly here over the last 6 to 12 months. So we really see that right now. Middle East is obviously a place where there's a lot of talk, and I think Aramco has put out pretty big growth plans in order to get from 12 million barrels a day to 13 million barrels a day. They're going to have to add a lot of rigs to do that. That hasn't really started to hit yet. So even if you look at like Schlumberger's results, if you look at their Middle East results, they're not up a lot over the last 5 or 6 quarters. But I think everyone's kind of expecting that to hit later in the year, as you hear what customers are saying and how things tend to be flowing. I think it's coming over the next year or two, but as you know, that all that is just a little bit later cycle than the U.S.
Right. And that, I sort of want to segue, and if there's other, we can certainly dive back and talk about more on the US and your business. And we'll probably close talking about the North Face thing. And I'm assuming that if I send you a mug for being on the podcast, I'm going to get an Innovex jacket. So I'm guessing this is how we're going to make this trade work so I can sport it in Denver. But I would love to talk about, because when we were talking about on the phone previously, obviously you're a private company, so you can talk more candidly. And we can, we can shoot to talk about ESG and investment and things like this. But what you're saying about Latin America and the Middle East, I mean, I think these are important in the context of right now, $115, $120, $120 oil yesterday for Brent, dropping to 116 with the rollover in the contract. But yesterday I had talked to a few different folks, and I just told a client, the estimates that you heard on TV, if you're watching Bloomberg or CNBC yesterday, were as low as 70, ending the year at $70 oil, and as high as 150. So pretty broad estimates for crude oil. And I would say, I think we are definitely we're probably at a geopolitical risk premium. I think we're probably at an not unprecedented, but historically speaking, we're up there in terms of probably $20 to $30, if not more. That is sort of this baked on price. Because when I looked at these crude oil export figures from Russia, they are at all-time highs. So yes, product import, the product side of the business and refining globally is tricky, and that is sticky, and it's moving around, and we struggle there. We also have, the Rockies aren't put, PAD 4 here in the Rockies and aren't, pushing the envelope in terms of refinery utilization. The West Coast is the same way for refinery utilization. And anytime you have obviously refining maintenance or anything globally, super heavy hit by COVID, people underinvesting on the refining side. So that's certainly impacting this. But I think in terms of actual crude supplies, from Russia and the exports, the fact that so much is being exported, it's not something that I'm, overly concerned about. In fact, it's interesting because I think this risk premium is put on, what could happen. And, if Russia was to be not kicked out, but to be sort of pushed out of OPEC a little bit. And I think the risk is actually more production than less, because you're now starting to, you're seeing Iran and Iraq. You're seeing countries have to actually lower their price of their barrels to get it into Asian market, because they're competing with a severely discounted, Russian Ural barrel. And that's relatively significant. And that actually harkens back a little bit more to, crashing, raising production and crashing prices. Not the same thing. Obviously, we're not raising production. But if you're lowering your prices and you're competing to get in, then you think of like, okay, well, 6 months from now, if demand is not as hardy as it is right now, even if it's 500,000 barrels a day or a million barrels a day and it's off, then that picture starts looking a little bit different. And I think that sort of risk premium placed on crude also looks a little bit different. And the risk is then more to the downside than it is to the upside. So I just feel like from a fundamental perspective of supply and demand, I feel like oil prices, certainly the estimates for 150, not that I can't get there, not that traders can't take there, but I think it's a little over its skis. And I would love your perspective as a, service provider in the US, and just you personally. What are your thoughts on that?
Well, yeah, fascinating topic. I think in my 20 years in the industry, I found that my crystal ball on oil prices is terrible.
Shocking.
So, so I think what we try to be good at is it's very unpredictable. So I think as the way I look at leading a service business is we have to be able to respond effectively, whether oil goes to 150 or whether it goes back to 50 or something like that. So I think that's what's
Absolutely.
most important for service companies to be able to survive through these ups and downs. So that's how we think about the world. So I don't really plan our business based on how good a prognosticator are we on oil and gas prices. But in general, I would say I'm probably a little bit more optimistic than you are on it. I think the U.S. is going to struggle to add production more so than we have in the last couple, like let's say 15, 16 or 17, 18. I don't think we'll be adding 1.5 million or 2 million barrels a day the way we did last go around. So I think that's going to help the supply side a little bit. I think China's demand is still dramatically suppressed due to their zero COVID policy. I don't think that can persist forever. And then I think OPEC, although they're going to grow, I think they don't have the same spare capacity that they did 10 or 20 years ago, as in my view, partially evidenced by the fact that they're talking about adding a lot of capital and a lot of rigs to make relatively modest growth in their actual productive capacity. So I agree with you. There's some kind of premium built in today that probably does ease over time, but I still think we're going to be in a point of some prices, pretty robust prices relative to where we've been over the last 6 or 7 years, will persist for the next few years.
That's fair. I mean, I think I disagree with it on a few levels, because I think there's a thesis. And it's a similar thesis around the business. So it's not that that's fair to disagree with, because most people disagree with me on it, and that's because I think in my 10 plus years in the business now, I've never seen that shortfall of invest. Now, I really do think the ESG investor pressure is fully contributing to a shortfall of investment from the public space. And I would like to talk about the public and private E&P in the US. But when you compare publics and privates in the US, privates are going gangbusters, $100+ oil. I am not concerned about the privates poking holes in the ground and output. So unless we're heartily concerned about the productivity, the losses in productivity, which I'm actually not seeing on a decline curve basis. So it's a little harder for me. I don't think we'll necessarily be growing 2 million barrels a day in the US, but we're growing output. And the problem is when people look at the data, they haven't seen it in the last several months, right? 2 months, EIA lags 2 months. When you get full, concrete, complete data, it's about 2 months delayed. And so when you have to see that, it's got to start growing, because the rig count just keeps edging upward and we're poking more holes in the ground. However, that being said,
I guess I have a question for you on that front, because I don't
absolutely.
follow the well productivity as closely as maybe I would like to. But my gut feeling is like we still have a lot of tier one acreage in the Permian. People are still getting more efficient, so probably productivity is still going to grow in the Permian, but that in the Bakken or the Eagle Ford, that we might be more through that really true premium stuff. So places like that, you might see a bit of an offset and might see new well
Yeah,
productivity decline a bit. You think that's fair, or is that?
Well, one, the question's great, and I wish more podcast guests would ask questions. Because I think so. There's a couple reasons. If you pull all the wells and you just pull Innovex or probably IHS or anything, you pull all the wells in the lower 48 of just horizontals, and you throw it together, the major shale plays, and you look at the normalized decline curve. It's actually it's edged up each year. Now, COVID, obviously, during 2020, you had far less wells being drilled. So there's a component of that. A lot of people will tell me, hey, now we have a lot of upspacing. So, of course, wells are going to perform a little better. However, something really important to understand is that between the Bakken, the Eagle Ford, the Powder, the DJ, the Anadarko, and the Permian, all of them collectively have edged up a little more. And Midland is sort of flattish on a decline curve, but you're not seeing a you're drilling wells with significantly longer laterals. You're not seeing a significant diminishing marginal return, and you've lowered those costs. So there's something to be said about that. And then we're actually seeing in the Delaware, the well productivity actually still increase. And part of that, we're seeing massive gas output increases in a decline curve from the Eagle Ford. We're also seeing that in the Delaware. And the thing with these oil prices that people have to realize is that I've never really appreciated, or I've never really liked the tier 1, tier 4 acreage, because I think it's a bunch of BS. When people mention it, it's like, are you showing me a map? Did we get every geologist in the US to agree that that's tier 1 acreage? It's kind of BS. So, and every operator says this acreage is good, I'm keeping it. This acreage is bad, I'm selling it. And then the operator who buys that acreage says, oh, but this is great acreage. So clearly, that tiers is in the eye of the beholder. And at $100 oil, that tier 1, tier 2, tier 3, tier 4, all the baby needs to get thrown out with the bathwater, because tier 4 acreage starts looking pretty damn sexy at even $70 oil, let alone $100 oil. So that's when you're seeing, when you look at the map. So if you break out every play, which I do, and I look at each basin, and you look at where the public and private operators are at, the privates are just everywhere, and they're not where the publics are at. They're on the fringes, they're doing stuff, and they can afford to take those risks because they are private, and because oil prices are so high and gas prices are really high. So now not only is the gas drive, in a great Delaware, when you're deeper and you're more thermally mature and it's great, you get this huge gas drive, and it's driving that up. So yes, you have massive gas production, but you also have that oil production. And so I think people are maybe forgetting a little bit that high oil prices, I'd say they mask, varying API gravities. They mask these high gas cuts. They sort of, all things are great. We're producing this stuff, and yes, we have to deal with the product streams, and we have to move this stuff around. But at these oil prices, sort of everything's wanted. So I think that we have to be careful on. I wouldn't bet against the U.S. shale sector. I sure as hell wouldn't bet against privates. And I think that we have to be careful about the upside potential. I think it's much more significant from a technical rock standpoint. We have decades of running room left in the U.S. And we're not even talking about just on shale gas, and being a smaller molecule. It's easy to get out of the ground.
That's a different story.
I think we have a significant amount of running room there. And then when we think about the stuff abroad, the fact that you're hearing that the uptick, and I see the same thing in Latin America, starting to see the uptick. And I think people probably aren't appreciating, yes, the market looks tight now, but the only people that are focused on ESG, and in the environmental pressures for drilling and completing wells, is the democratic countries that should be producing it, is Canada and the US and Europe. So the folks that don't give a rat's behind about environmental social governance is Latin America, is the Middle East, is Russia, is all these places that are producing a ton. And they're the folks that, they're very good. OPEC is They tend to focus on supply. They're not very good at demand. And actually, they're not even always good at supply, because OPEC can't control Latin America to a large extent. And so when these prices are this high, when they're sustainably this high, one, it erodes the economy and you hit demand, but also you're ramping up output. And so what you can get yourself into a situation is where production has ramped itself up and demand is starting to come back off. And it doesn't have to be a cratering in demand. It just means a softening in demand and that production ramping up. And that's a stabilization for the market. But it's just a reality that I don't think we can hold back, anyone who's not a public company and ESG focused in the Western world is not going to be worried about any of they're not going to stop that investment. So the shortfall of investment, yes, it's struggled, but that's mainly because of COVID and a number of things, and just getting folks off map. And the fact that Europe is now doubling down on, they're doubling down on the Middle East. They're basically going to the Middle East to secure their supplies. So the Middle East is going to have to continually increasing output. And we're looking at OPEC's producing 30 million barrels, almost 30 million barrels per day. I'm sure the April number or the May numbers June numbers will show a little higher for May. But about 30 million barrels a day. So this spare capacity thing that, yes, it's basically UAE and Saudi Arabia. But I struggle with this spare capacity, because it's like, when you need it, do you drill it? And if not, and they're just raking money in, they're raking money in, or raking it over the coals with
it's true.
Right,
and their reservoirs are prolific. Even the stuff that they're developing today, a little bit closer to Saudi than the other places. Their tier 3 acreage is unlike
exactly
over here. That
Exactly.
100% is makes sense.
Yeah, so I think from a technical capacity, we just have to be very, very careful in the business because what you
Yeah,
articulated is definitely a thesis in the industry, and it's a valid thesis. It's something that I spend a lot of time thinking about. It's valid. It's just that there's a lot of nuances there, and I think that I do think that where the global economy is at. I mean, a few couple weeks ago, we had Target and Walmart earnings calls, and I know we talked about this over the phone, but they were atrocious. They were,
yeah,
and the market, most people probably didn't. I don't know how many folks actually listened to them, but the market dove on it on Target. Walmart was the day before, but Target earnings had dropped 25%. Your Target, the stock dropped 25%, and that was because Target had said how bad oil prices were impacting them for transportation costs, how much the consumer had shifted their spending, that they weren't buying bikes and TVs and stuff, and they were spending on food. And Walmart the day before had said, hey, we've got double digit food inflation, and they painted a rosy picture saying, hey, we'll do better in this crisis the most. But I mean, and you buy Walmart in a recession, they're the stock that does well. But I mean, they were saying, hey, people are buying food because that's all they can afford. And that's a really serious
yeah.
thing
That's
that
a
I think
shame.
is slow to get into sort of the oil market in terms of folks really appreciating that where demand is going to be. Demand is held up because we've had this post-COVID wave and everything, and people still wanting to drive and travel. But I think it's very, very serious from a demand perspective, and in terms of where the economy is at, and is demand
Yeah.
supporting, is this $115 oil driven by demand? And no, I don't believe it.
Yeah, I mean, I'll go back to what I said earlier. I don't think we know. It's hard to predict. One, I would say, hey, what we're seeing right now in terms of increase inflation, energy, food in particular is tragic, and it hits those who need energy. Those who can least afford it are hit the most with it. So it is a shame to see. I think that on the demand, I'm a little bit skeptical of the demand destruction story that people worry about with oil price. I mean, we shall see where it shakes out. But I think one, like the further I would say, is like we're drawing a lot. Again, I'm not probably as close to these things as you are, but you look at obviously OECD oil inventories; they
Mhm.
continue to draw, counter seasonally. So I think that's another marker that we're still undersupplied. So even if demand does, we do shed a little
Absolutely.
bit of demand.
Absolutely.
I think we're probably expecting that, and we probably can't continue to release oil from the SPR. So I think all of those things say that we're structurally very undersupplied today. I think so. All the stuff you're saying is true, but I think over time, that probably bounces that to a place where things probably soften a little bit. But I don't think we're getting back to what we saw even pre-COVID, and with respect to energy prices, for better
And
or
do you
for
think
worse, probably depending on where you
A-
sit on that.
Absolutely valid. Absolutely valid. And there's a number of different things from an inflationary standpoint, gas prices and everything. And actually from a tipping point for what's going to impact the consumer, it is not just oil prices alone. It's everything else being really high and high oil prices. But that being said, I'd love to the E&Ps and the business that you're seeing, I mean, there's a podcast that'll be released this week this one will be released after. So I encourage listeners to go take a listen to it. But I talk about this new sort of $100 oil. And as you say very well, you clarified very well. It's very hard to predict oil prices, and that's true. But if you were a public company, you'd be opening up and talking about the macro, and you'd be talking about oil prices, and you'd be talking about strip
Mm-hmm.
and how great things are. And I always say that strip is, you can put the curve on a chart, which I do, and say I've never seen oil prices look like this. So I've never seen oil prices just be $100 nice and smooth, and everything's
Yeah.
great. But that being said, I mean, your business is directly to E&Ps in the U.S., and we do have a $100 oil market. I would say it's new. It's not like people like as the footing on it. They don't feel quite as like, hey, we're going to be here forever. So I'm just really curious from a business perspective, and you're being private, so you can be a little more candid. Is it like people are going gangbusters? Like, hey, we're there. Let's go back. We need everything, or is that also things are tight? So you're trying to get things, and how is that sort of looking from both a public privates and the inflationary aspect, the tightness in the market, and how it is working out in the wash for you?
Yeah, no, so I think in general for our business, we're probably in as good. I've been at Innovex or a predecessor company called Team Oil Tools for about 7.5 years, and I think so I started like December 2014. My first working day was right after the OPEC Thanksgiving meeting in 2014, and since that time, this is probably the best macro backdrop, and I feel as good about the macro in the industry as I have over the last 7.5 years. Our customers are certainly getting more active. Yes, the privates have led the way on that. The publics are a little bit more constrained, but honestly, they probably couldn't add more. The industry couldn't add more to the U.S. because of all the different supply chain constraints we're seeing, which again, hopefully is good for our business. As you know, we've had this tendency to
Absolutely.
overinvest and destroy the good times. So hopefully some of the supply chain constraints actually helps us stretch this out a little bit longer rather than get too much activity today just to watch oil price turn over to back to $30 next year. But yeah, it's very tight. We're seeing a bigger call on products, and as you said earlier, we are much more levered to well count, lateral length, frac stages than we are to say rig count. So we definitely benefit from wells getting longer, wells getting trickier, and our customers needing to do more to properly drill and complete those. So that's all been a tailwind for our business. The supply chain stuff has certainly been a challenge just to stay on top of all the different shortages, and creates a lot of challenges for our supply chain folks who have navigated that pretty masterfully in the total. But for sure, we've seen cost on a lot of what we do rise. A big part of our business is, steel is probably the single biggest input cost into our business. As you've seen, OCTG pricing is up like 300% or something, just unbelievable, and continues to go up. And that's had a big knock-on effect on the price of our product. So we have had to, substantially increase pricing over the last 6 months, and I don't think we're through with that. And you never want to have to do that, of course, to your customers. But at the same time, hey, we need, as a service industry, as you alluded to before, the industry has historically been whipsawed by the E&Ps, and it's been tough to get good returns in the service
You
industry.
need to make money.
Particularly on the capital side of it. If you're selling consumable products, you're not quite as exposed to that, or our business model tends to be a little bit more adaptable to that. But nevertheless, you have to generate money and you have to generate good returns. And I think our customers understand that, as long as you're working with them and are reasonable with them on how you kind of ease these price increases into their program, so that they can plan forward on future AFEs and things like
Absolutely.
that. But at this point, nobody's surprised when you're like, hey, unfortunately, we've had these cost increases, and we're going to need to pass some of those along.
And so you're directly benefiting then, significantly from probably seeing a steady uptick as, folks, as the industry came out of COVID, and the privates were quicker to respond and always are to higher oil prices. So those privates, and as oil prices really ratcheted up, they're more willing to do the trickier wells, to deeper wells, horizontal. There are definitely publics that are doing some deeper wells and stuff now, but that seems to benefit you. But also the privates are a little more chunky sometimes in nature. They don't always have a consistent completion pro. Like, hey, we've locked in that frac fleet for the rest of the year, whatever it might be. It might be a little chunky. We do it here, we do it there. So it's a little bit different. I think clearly the thesis that the privates couldn't get the capital from is dead, because we're seeing the privates off to the races. So that's why I struggle with sometimes these big mega theses that everybody has. So privates are getting the capital and they're doing this, but they are a little chunky. And sometimes even the smaller ones can be, hey, we're still giving you, if that well's good, we're going to give you the rest of the money to do this. That's not exactly how a good business works. You sort of to let them develop. But then in your instance, you still have to have the inventory. So it's not as though those privates are being a little chunkier in nature. Has that sort of been relatively smooth because there's just so many going at it, or is it a little bit chunky, and then the publics are pretty smooth because they're just going to buy large chunks at a time?
Yeah, so most of the way that we sell product in the U.S. is we tend to do it on a follow me basis. So as a rig shows up, or a frac fleet shows up to a location, we tend to deliver the equipment to that location that they need for that 4 wells or 6 wells, or whatever the case might be. So so it doesn't meaningfully change our demand signal, whether it's let's say a big independent running 5 rig, or like let's say 4 or 5 big independents running 10 rigs, or just an XTO running 10 rigs. We kind of tend to see a similar demand signal, if that makes sense. We certainly saw pre-COVID to post-COVID a change to where pre-COVID, definitely the top 5 customers were the usual suspects of mega independents, and that's the major integrateds out in West Texas, as you would imagine. That's probably still the case today, but they probably represent a smaller proportion of that share than they did 3 years ago. But as far as how it's impacted our business in aggregate, it hasn't tremendously. You do see probably one of the big things we struggle with is just the mass variability in what we do. We sell a lot of float equipment, for example, and you would think float equipment is not that diverse, but it's very diverse for a whole variety of reasons. And part of how we're successful in the market is we're able to accommodate all of our customers' changes in casing string designs that can change even from one operator, depending on which pad they're on or where they're at in a given basin. They'll change their casing string design, the thread profile that they're using, and all of that impacts the product that we're delivering. So a big part of our business is building an inventory that's almost complete, and then as customers pull up to a specific location, being able to make those last minute changes to the equipment, threads being a big one, for example, where you'll make that just in time and deliver to the location. So being able to stage that inventory where it's almost complete, and then we're able to make the last finish it off, has been a really important part of our ability to grow market share over the last few years. But whether it's public or private, I would say that in particular hasn't driven that in and of itself hasn't driven probably a huge change in how we approach the market, I would say, or how we see that demand signal.
Absolutely. Okay. No, that makes total sense. And I would say that you're probably seeing that. I mean, I know a lot of well designs. I've heard of a lot of adaptations with the inability to get steel or the cost of steel, and the little bit of a certain size of casing and that changing stuff. So I mean, I feel like people are getting relatively flexible in how they're doing these wells, and that has to impact you because obviously the stuff that you're putting down there has to.
We talked to adapt to that. We had a customer in the office last week, and they're smaller folks. So actually, this flies in the face of what I just said, because they're real small folks who drill probably a dozen wells a year, and they typically buy pipe on the kind of third hand, let's say, or from the excess and obsolete pipe from others. And like the well they were on right now, I think they were going to run on their production string. They were going to run like 3 different thread types because that's kind of what they could put together. And so that kind of stuff could impact us depending on how folks approach those kind of challenges.
Yeah, no, it's all a valid point, and it does impact sort of the stickiness in the market. And to your point about whether or not the U.S. could grow, I mean, these are all extremely valid. So, I think I can't let you go without the 2 things I know we talked about, and you won't be now that obviously we weren't recording our phone conversation, but we were talking about ESG and investor pressure, and ripping on the net zero IEA's net zero thing a little bit on the 2050, and actually me a lot bit. Have plenty of problems with that, as most listeners know. But I also, you became, I don't know if, obviously you were known, but a lot of people know you from the jacket incident with North Face and the inability.
Yeah, we sell oilfield tools too, but yeah, I know what you mean. Yes, exactly. I tease, yes, that's
exactly. That you sell oilfield tools, and that's why I didn't want to start and preface this, because I'm sure a lot of people bug you about it. But that being said, especially in Denver, because Chris Wright bought a billboard. Yeah. Downtown and put thank you, North Face and everything. So, and obviously that is directly because of you. So it certainly increases awareness. I mean, I have a very expensive North Face jacket that I bought when I didn't have the money to buy it in like 2014. It was like $100 jacket, and I don't even want to wear it anymore without I need to cover up the thing on it. But that being said, so you went to North Face.
Patch.
What exactly?
You can send you a patch.
Yeah. And I sew, so I can sew that patch on there. So you went to North Face. You tried to buy some jackets. They told you no, and then you just released this stuff publicly.
Yeah, no, I think IT's good. That it's crazy. That's been the probably best free marketing we've gotten over the last year and a half, and to even today, if I meet with folks that I haven't seen in a while or new people that I meet, that topic will frequently come up. I think it was to tell the real quick story on it. To the extent people don't know, yes, we were denied jackets by North Face. I wrote a letter that I sent to the CEO of the VF Corporation, the parent company of the North Face letter. I didn't expect to get any response from them. I really wrote the letter and posted it because I think it's really important for the culture we want as a company, or for any company, for the employees to feel that what they do is a force for good in the world. And I've had not a lot, but I had one specific conversation I can think about a month before I wrote that letter, where somebody was one of the people within the company had said, well, we're in the oil and gas business, so our day job, it really doesn't help anybody. So on the weekends, I try to do things that are good for the world. And I thought that view was something we need to dispel. And that's one of the reasons why, that's the primary reason I wrote the letter, is I was hoping that some, if not most of the employees at Innovex would read that letter and would respond to it. And I don't think it's something most people within the industry even think about, how valuable oil and gas is and how critical that is to human flourishing and our prosperity. I think it's taken for granted across the world, or certainly in the U.S. and Western Europe, it's taken for granted. I think to a point you made earlier, far less so in developing parts of the world where they really are desperate for more energy. And the vast majority of people who live outside of the U.S. and Western Europe basically live off very little, no or very little energy. And I think they would relish having the access to energy that we in the Western world have. So I think it's pretty disingenuous of folks like the North Face, who benefit tremendously from the products that we produce to basically demean our industry. And it's really hard to change the narrative on that, but I think my view has come around to, hey, one of the things I'm trying to do, and I think Chris does an awesome job. He's probably the best spokesman our industry has, is to, at the very least, change what the industry thinks of itself. Because if the industry doesn't talk positively about what we do, then who will?
Well,
so I think it's actually pretty frustrating when I see a lot of people within the industry either make these implicit or explicit arguments that, yes, the world needs to and should move beyond oil and gas. But to be clear, like the day that there's a better alternative out there that's lower cost, more reliable, we should pursue that. But I think we should unabashedly celebrate what we do. Like all things in life, there's trade-offs, but humanity has prospered in a way that was inconceivable 150 years ago because of oil and gas. And it's not incidental to that progress. It is fundamental to the building block of every single part of modern life.
Well, and I think you make an excellent point that we talked about over the phone too, is that I think it's industry leadership to me is extremely frustrating, is that I don't know if people realize that, and I know listeners of the podcast range from sort of CEOs to folks within the industry, but it's like when these CEOs are making these big net zero commitments and they're downsizing the folks that are in the field, and they're increasing their environmental groups, and they're really selling the ESG story to the street. I think that they have to be very careful, and what Chevron has done with their massive flip between, saying before the shareholder day last May, and before that call, and what happened, in May with that shareholder flip, Mike Wirth was very open about saying, we're going to produce this crude oil. We're better at it than anyone else. So we're going to produce a lower carbon barrel, and the world needs this crude oil. And we can do it safely and securely and better. And then that changed, that sort of narrative changed because they got this pressure. And that's what really struggles, is that, well, the people that work for you, you need, you're producing a commodity, a very valuable commodity that the world is consuming. And it's an ESG crisis in and of itself to have an energy and food crisis that we have right now. And so for every barrel that, every dollar you are investing in lower carbon, lower energy, lower BTU output, you are contributing to this energy crisis. And that is a little bit frustrating. It's very frustrating to me when you're, when billions of dollars of CapEx are going to extremely low energy output, that's not necessarily even getting tied into the grid, and doesn't, you're doing wind and solar. That's not a direct offset for actually crude oil or natural gas. So that's a problem. And then it's the bigger problem of that you have trillions of dollars that have left the space from an ESG perspective from the fund side. And I want to look back to the response from North Face, but the Deutsche Bank thing that happened, which I was mentioning to you, is that, Deutsche Bank is in this debacle right now where they had a whistleblower, somebody that was fired, then whistleblowed and said, hey, your ESG funds aren't that ESG friendly. And I had Dan Pickering, and I've had others on the podcast, or not Dan Pickering, different funds on the podcast where I'm looking at their, green fund, and it's all oil and gas with a little bit of renewable. So even the green funds,
they're more, those oil and gas businesses are like, deemed to be more acceptable because
right. So it's just like, well, okay, so is this a renewable or not? And that's where I call BS on that completely. But it's the same. So Deutsche Bank is getting in trouble for saying, we're ESG friendly, but all this stuff they're saying it's not. And it's where it's elevated the E so much. It's all about the environmental stuff. It's just all about carbon. And the S and the G and the real humanitarian stuff, with an actual war going on in Ukraine, with an actual, food and energy crisis, with people not being able to, heat and cool their homes, with not being able to buy food. This is an ESG problem. And so I think this callous, to me, it feels a little callous to where we're like, hey, let's work on net zero for 2050. It just seems complete disregard the human aspect.
Yeah, no, I agree. And I think it's just shows an incredible amount of privilege to say, for those of us who really don't,
yes.
It doesn't impact a lot of the people's lives directly who are having these calls to not invest in oil and gas. Their lives are not particularly impacted by these issues. For them to push these topics that have a major impact on people who need energy the most, either in our country or around the world, who suffer from a lack of energy, it's just disingenuous virtue signaling, in my opinion. And to your point about ESG, I think as an industry, we have room for improvement in a variety of different ways. But I think if you ask, hey, should we do right by the environment, take care of, do a good job for society, and should we have reasonable governance? I think the answer is we agree on all of those things.
Absolutely. And I don't think anyone in the industry would say, no one in the industry would say, increase methane emissions, reduce it, do all these things. But that's different from, it's doing right
I think
and doing
right.
it well.
Yeah. And we have people, with respect to the environmental one, I think our industry, a lot of people who are in our industry are there because they enjoy the outdoors and experience them actively in many different ways. So I think we're probably, as an industry, I'm hard pressed to see another one where people enjoy the outdoors as much as folks in the oil and gas industry.
Exactly. And I think if you've grown up in the business like I have, and you spent time outside and you're literally in the element. So you have to have some kind of grit to you. But also that's where I think it's different. We're talking about environmental and concert. We're talking about people who that's where I take a hard time with ESG at all, is that because the E, which is environmental, is actually just about CO2, is actually just about carbon. And it's so anything else is moot. And that's where the investor side really does matter from the public space, is that as the publicly traded companies accept and endorse and adopt this narrative that they're being, that they're cheerleading it too, really drives me crazy. It's because they need to push back on it, because the agenda and goal is not for them to prosper and to do really well and their stock prices to go up and increase output. It's so that they dwindle and they're not there anymore. That's the whole point of pulling the trillions of dollars out of these businesses, and so people can invest. So I think these businesses have to be careful about how they're actually doing this, because at the end of the day, they're thinking we have $115 oil right now and stocks are up, but they're touting this ESG thing. And I think if oil prices were to go to 50, I'm not sure the ESG narrative, because it is investor pressure, would look the same. I think it would.
It's hard. Prices, yeah, and in fairness, I've been on that side where for some time with Baker Hughes, I was responsible for communicating with the investor set, and it's a challenge. I certainly appreciate that a lot of those folks are in between a rock and a hard space, and it's very easy for those of us who aren't in those specific seats to make those decisions. I'm blessed that I get to work not only in the industry, the business that I lead is a wonderful business with great people, but our investors understand the business. They're great supporters of this. I think they understand where we're coming from in many different respects. Whereas if you're in the public market, you have a bunch of different investors with a divergent set of priorities. So it's a challenge for those folks for sure. But what I would say is I agree with you. I think ESG, when spoken to holistically, the fact that, hey, we need to take care of the environment and create a good environment for people, I think the S piece is one where the industry should really celebrate the fact what we do to create, not only does the product we provide fundamental to human prosperity, but we as an industry, particularly in the U.S. and around the world, create a lot of great jobs for a lot of people that are very high-paying, rewarding jobs for people that didn't necessarily go to Harvard Business School, that can go to West Texas with a high school degree and have a great job where they can really flourish as individuals and as a family. I think it's there are other industries for sure that can do that, but we provide great jobs for people. I think the governance part is another one where our industry has probably struggled the most with, in the sense of overinvestment and sometimes lack of alignment between the shareholders and management. Many things have led to some probably questionable decisions over time, which has led to some of the capital destruction, which has led to some of the I think the investors really beating the ESG drum in some ways as a way of using CO2 mitigation as a kind of a classic bootlegger and Baptist example, where the folks that have been burned by the capital destruction in the industry have taken up this mantle of CO2 reduction as a way to explain why they're not going to invest in the industry going forward. But I think the industry operating responsibly, I think the industry doing a better job of celebrating our story and how what we do is fundamentally uniquely critical for humans, as well as do a better job of generating returns over the longer term. I think those things will work together to improve that narrative over time.
And I think that's exactly it, is that, I think it's ridiculous and unfair not to separate, that's why I always say investor pressure and ESG is kind of one, because it is about shareholder returns, and it's about carving your space in a long only portfolio and getting fund managers to listen to you, and to hold your stock. And the industry, though, you're producing a valuable commodity, and to your point of doing it, uh, the point of saying about doing it in North America, whether it's Canada, whether it's the US, or whether it's in the North Sea, is that these are kind of the only places that actually have, stringent rule of law, high, very high emission standards, the ability to say this is a humanely sourced barrel with very high degrees of safety that has, checks and balances that, it is very, has functioned for a long time. So the humane side of the barrel, the lower emissions barrel, it's all really serious, and we can do it here. So I think demonizing the industry, demonizing itself, and trying to reduce these emissions and everything, it's going to, investor pressure, I always say, is transitory, unlike inflation. And, you had to buy into the Permian at any and all costs at $60,000 an acre, not that long ago when oil prices were $50. And now you have to do all the crazy stuff on ESG that doesn't even have a perfect metric. And the problem is that, people have to, especially investors, even have to be careful with this, is that at $100 oil, everything looks different. And so you can tout all this stuff and you can talk about it and everything, but it may not hold up in terms of an investment thesis, and how the stock's going to hold up if oil prices were to drop to 70 tomorrow. And I just think that's important, is that this is we have to be, you're also producing a commodity, and this is how it works. And I think the industry and leaders in the industry also have to be more vocal about, we produce it really well. We are ESG friendly. And this is why. And here's what an ESG crisis really looks like. And that's what Chris Wright and Liberty do really well, is explaining, they have a different take on ESG, and this is what we're going to do. And I would say that takes real leadership in the business, and we need to pursue that. And obviously, your talk on North Face, and I didn't mean to cut you off there, but North Face did respond to you, correct?
They actually never responded to me directly. Eventually
publicly,
they did.
Yeah.
Publicly, they did post something. It's actually been a while, so I forget exactly what they said, but it was something to the effect of, "Hey, they reserve the right not to sell product to whoever they want, and they do think that the world would be better off with less oil and gas, so they were going to do everything they could to start to recycle products that are used in their jackets." I think their approach, though, is very focused on their product and how they're going to celebrate the 0.15% of their products that are made with recycled petroleum products instead of new products. But that's even only a small part of the story. I think what they, as well as many folks who share their views, misunderstand is that the whole outdoor industry would not exist without oil and gas. One, we wouldn't have the prosperity to be able to go skiing or go hiking, but there's no way that you could support the ski slopes in the middle of the winter in Aspen, Colorado without oil and gas. There's not really a credible renewable solution anytime on the horizon that's going to make that happen. So you just look at every activity that they celebrate, the activity would be implausible for humans to embark upon without oil and gas. So yeah, it's fine that they're going to make a little bit more stuff out of recycled material, but that doesn't change the fundamental point that their industry wouldn't exist without oil and gas.
And they didn't sell you the jackets at the end of it. Conclusion.
At the end of it, they did not sell us the jackets. No. So we went to a second, an alternative supplier for the jackets.
Well, I think it is great free publicity, and you should always take that up. And clearly, we've spoken on the phone before, and you've been an absolute treat and pleasure to have on the podcast. I love the service sector. I like that you disagree with me on the market, which is great, because I don't like groupthink in lots of things, and I like pushback. So I think that's awesome. And if you have any, I'll let you have any last thoughts or things you want to mention.
No, I think we covered a pretty broad array. I appreciate you having me on the podcast. Enjoy what you put out there and your insightfulness into the market. So it's been great.
All right, thank you. Well, I appreciate it, and thanks for listening, guys. See you next week. Bye.
All right, bye.